Why does a small increase in investment sometimes create a much larger increase in national income? Why can excessive aggregate demand create inflationary pressure? And how do fiscal and monetary policies stabilize the economy? We begin with the basic national income identity for a simplified closed economy with government. National output equals total planned expenditure in the economy. Mathematically, Y equals consumption plus investment plus government spending. This is the expenditure approach to measuring national income. Consumption represents household spending, investment represents business spending on capital goods, and government spending represents public expenditure. Together, these components determine aggregate demand. But national income can also be viewed from another perspective. Income received by households is either consumed, saved, or paid as taxes. So we can also write Y equals consumption plus saving plus taxes. Now notice something important. Both expressions equal national income. Therefore, consumption plus investment plus government spending equals consumption plus saving plus taxes. Subtract consumption from both sides. We obtain investment plus government spending equals saving plus taxes. This is one of the most important equilibrium conditions in Keynesian macroeconomics. It means that injections into the economy must equal leakages from the economy. Investment and government spending inject expenditure into the circular flow, while saving and taxes withdraw expenditure from it. When injections equal leakages, the goods market is in equilibrium. Next, Keynesian theory assumes that consumption depends on income. The consumption function states that consumption equals autonomous consumption plus the marginal propensity to consume times income. Autonomous consumption represents spending that occurs even when income is zero. The marginal propensity to consume measures how much additional consumption occurs when income rises.
Suppose households spend 80% of every additional unit of income. Then the marginal propensity to consume equals 0.8. Now substitute the consumption function into the national income identity. Output equals autonomous consumption plus the marginal propensity to consume times income plus investment plus government spending. Move the income term to the left side and factor out output. Solving for equilibrium income gives us the Keynesian multiplier model. The multiplier equals 1 divided by 1 minus the marginal propensity to consume. This multiplier explains why small autonomous changes can generate large changes in national income. Suppose investment rises by 100. That 100 becomes income for workers and firms. Households spend part of that additional income. That spending then becomes someone else's income. The process continues throughout the economy. As a result, total output rises by more than the original increase in investment. This chain reaction is called the multiplier effect. We can now generalize the model. Aggregate demand can be written as alpha times autonomous spending plus beta times real money supply. Alpha represents the spending multiplier. Beta measures how strongly aggregate demand responds to changes in real money balances. Autonomous spending includes autonomous consumption, investment, government spending, and exports. Real money supply equals nominal money supply divided by the price level. This framework combines fiscal and monetary influences into a single aggregate demand relationship. The fiscal side works through autonomous spending and multiplier effects. The monetary side works through liquidity and interest rate channels. When real money balances rise, interest rates tend to fall. Lower interest rates stimulate borrowing and investment, increasing aggregate demand and equilibrium output.
Now let us apply the theory numerically. Suppose full employment output equals 2000. Initial autonomous investment equals 400. The spending multiplier, alpha, equals 3. And, the responsiveness of aggregate demand to real balances, beta, equals 2. Investment rises by 10% in period 2. This increases investment from 400 to 440. The increase in investment equals 40. With a multiplier of 3, output rises by 120. Output therefore increases from 2000 to 2120. In period 3, investment rises again from 440 to 484. The additional increase equals 44. Applying the multiplier again, output rises by 132. Total output therefore reaches 2252. Notice that output now exceeds full employment output of 2000 units. This may generate inflationary pressure. Graphically, rising investment shifts the aggregate demand curve to the right. Initially, the economy operates near full employment. As investment expands, aggregate demand shifts outward. The multiplier process amplifies the increase in expenditure, pushing equilibrium output above full employment output. This creates an inflationary gap. An inflationary gap occurs when actual output exceeds full employment output. Aggregate demand becomes excessively large relative to productive capacity. Firms face rising demand pressure, labor markets tighten, input costs rise, and prices begin increasing throughout the economy. This is demand pull inflation. In the graph, the shaded region beyond full employment output represents the inflationary gap. As aggregate demand continues shifting rightward, the gap becomes larger. To stabilize the economy, policymakers may use contractionary fiscal or monetary policy. Government spending can be reduced to offset excessive aggregate demand. In our example, output increased by 120 units in period 2. With a spending multiplier of 3, government spending must decrease by 40 units to offset this additional increase. Alternatively, the central bank can reduce real money supply. If the responsiveness parameter equals 2, real money supply must decrease by 60 units to offset the same increase in output. Through these policy tools, the economy can gradually return toward full employment equilibrium.